2 words, Revo Fitness. Here's a few more. Simple, 24/7, reformer Pilates, body scanners, massage chairs, squat racks, free weights, pin and plate loaded equipment, no lock-in contracts, no bullshit. All of that and more from just $9.69 a week. That's surprisingly affordable. Join now at Revo Fitness Victoria Park or download the Revo Fitness app. RevoFitness.com.au or find the Revo Fitness app in the App Store.
Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Is the ASX in trouble? James Hardie is set to merge with US giant AZEK, AZEK, in a move that will see the new company's primary listing on Wall Street, a secondary listing here on the ASX. There was a similar story when Australian gold miner Newcrest was bought out by Newmont last year. The new company is still listed here, but as a secondary listing. More and more investors are buying US shares, think the Magnificent Seven, and with a couple of exceptions, we're unlikely to see any major new listings here on the ASX anytime soon. Think Canva, Airwallex, they're likely to list overseas. So what's that mean for the ASX? As always, this podcast contains general information only, and you should seek professional advice before making investment decisions. We speak regularly to Roger Montgomery, founder and chief investment officer at Montgomery Investment Management. Roger, welcome back to Fear and Greed.
Always good to be with you, Sean.
Just up front, when these companies are being taken over, in fact, just go through the whole building materials group, Adbury, CSR, Boral, this one yesterday, James Hardie. What's it mean for the ASX? Should the ASX be worried?
Well, you said in your introduction they're in trouble, and I think let me say this, I have some sympathy for that view. There's certainly a shifting landscape. And in answering the question, I guess you have to sort of think of a framework to come up with all of the reasons, first, why it's happening, and maybe some suggestions about what could be done to fix the problem. And the way to think about it maybe is in terms of supply and demand. So if we think from the supply side, there aren't as many companies listing on the ASX. Now, you've highlighted one reason. One reason is that in the US, there is an unparalleled pool of capital that just wants to invest in tech giants and innovation-driven companies. For a very long time, private equity and public equity markets have been more willing than Australian investors perhaps to support profitless companies and to value those in a way that appears appropriate to the founders of those businesses. So that's true, and that's one reason why we're not seeing as many IPOs in the Australian market. Another reason, I think, is that the listing process is convoluted in Australia. So when a company prepares its IPO documents, it has to lodge those with ASIC. ASIC takes some time to approve those, and in fact, quite a number of weeks pass. Now, if you've nominated the price that you're going to list at, but it could be 6 weeks before you list or issue that prospectus document, then the market could change. It's not a short enough time for the pricing to respond to market conditions. So that's a hurdle for listing in Australia, and that's something that many others in investment banking and particularly the people at Barrenjoey last year suggested needed to be changed. And then another issue is that for many business founders, there's a huge onus of responsibility when you're a listed company. You've got continuous disclosure, compliance requirements, and all of these ongoing regulatory requirements that you've got to meet as a listed company, which used to be attractive when private equity wasn't willing to pay a high price for your business. But nowadays, the private equity markets, the private equity pool of capital is very, very deep. Lots of people have put money into private equity because it doesn't have that public market volatility exposure to it. And consequently, private equity have very deep pockets. So they've been able to pay higher prices for businesses, founders to exit, or for growth capital, for example. And that has meant that the outcomes that founders might have looked for, exiting their business and selling it on, the IPO market or the listed market isn't the only avenue to pursue. You might get just the same price without the regulatory burdens by selling to private equity. And so now private equity competes with the public market for businesses.
How does superannuation funds feed into this? We know that when I put my money into my super fund and I nominate X amount shares and I say local shares, international shares, it's going to be difficult sometimes to actually find, if it keeps going this way, is it going to be difficult to find fairly valued companies on the ASX when you've got so much money going into super?
Yeah, well, you've got a lot of money going in. That's the weight of money argument. And, it's one I've heard many, many times. You do have a lot of money going into super every week, every day. And that now has a shrinking pool of companies on the ASX that money can invest in. And so, from that perspective, you would think that means mispricing is going to occur. And, and some people would argue that markets or prices of stocks will always be elevated as a consequence of that weight of money in a shrinking and more concentrated pool of companies. But the reality is markets correct. Markets do have crashes. And so, if it was the case that superannuation was always going to keep stocks elevated, then you wouldn't ever have crashes. But we know crashes do happen. In fact, the market's fallen 10% or so in February. So, so that's probably not always going to be the case that mispricing is going to be, on the expensive side, because we do know markets crash.
Stay with me, Roger. We'll be back in a minute.
2 words, Revo Fitness. Here's a few more. Simple, 24/7, reformer Pilates, body scanners, massage chairs, squat racks, free weights, pin and plate loaded equipment, no lock-in contracts, no bullshit. All of that and more from just $9.69 a week. That's surprisingly affordable. Join now at Revo Fitness Victoria Park or download the Revo Fitness app, revofitness.com.au, or find the Revo Fitness app in the App Store.
I'm speaking to Roger Montgomery from Montgomery Investment Management. So let's look at how investors should play this. And as an investor, broadly in the local market, but in equities more generally, much easier to buy international shares now than it ever has been. How should investors play these trends?
Well, it's interesting. I actually wrote this morning, not knowing that we were going to chat. I wrote this morning a blog post comparing the ASX 200 to the S&P 500 over 5 years, 10 years, and 15 years. And not only did I include the dividends being reinvested in the ASX 200, but I also gave 1.5% to 2% for the franking credits, assuming that an investor was a retiree in pension phase and got the benefit of reinvesting those franking credits as well. And so because they're in a zero tax environment. And what I found was that over the short term, there is some, and if you're an income investor and you like that stable income from the banks and to a lesser extent the resource companies, there's some merit investing in the ASX 200. But over all of those timeframes that I mentioned, the S&P 500, when you take into account withholdings tax and when you take into account the currency, the Aussie dollar depreciation, so that's the caveat there, the S&P 500 for an Australian investor beat the ASX 200, which is one of the reasons why more investors are looking to small caps for their growth. And by the way, I think the reason for that, Sean, is simple and relatively easy to understand. And if you look at the ASX 200, the bulk of the profits of the ASX 200 companies is paid out as a dividend.
Yep.
It's about 80% or thereabouts. And what does that mean? Well, that means there's only 20% of profits left to be reinvested for compounding. Now, sure, shareholders are going to say, well, I'd rather have the money. I don't trust CEOs and they always overpay for acquisitions and do stupid things with the money, so I'd rather have it. But maybe what's happening is in the US, it's kind of reversed. You've got only about a third to 40% of the earnings paid out as a dividend and the rest are retained and compounded for growth. And, the best example I can give you of that is Berkshire Hathaway, where, back in 1965 or thereabouts, Warren Buffett took over Berkshire Hathaway. The share price at the time was about $18. Believe it or not, he did pay one dividend. And then he said, I quote, thought better of it and didn't pay a dividend again. Now, if you'd bought $1,000 worth of shares at $18 back then, and that was a lot of money in 1965. Today, it's worth about 50 million US dollars. And so, you would have done incredibly well with no dividends being paid. And people would say, well, what do I do for income? And my response would be, well, sell a share for 750,000 US dollars. And if you want to have a good year, sell two.
Yeah.
So that retention of profit, and the caveat is the reinvestment of that profit at a high rate of return, that leads to compounding growth at a higher rate than if you pay most of the earnings out as a dividend and then you go and spend that money. And so that's a big difference. And that's one of the reasons why I think more investors are focusing on small companies, because many of those big caps in Australia are mature businesses and the small caps are able to grow.
So that blog post, where is it? Just for listeners to go and chase it up.
It'll be up in the next week or so, and it'll be at rogermontgomery.com.
That's worth it, because I've often wondered, when you take in depreciation, withholding tax, franking credits, how we perform. And I get that in the short term, 5 years and less, the Magnificent Seven probably gives us no chance. But in the longer term, the fact that the ASX has underperformed is quite incredible, I think.
Yeah, over 15 years, that's the conclusion I've reached.
Well, Roger, thank you for talking to Fear and Greed.
Always a pleasure, Sean. Talk to you again soon.
That was Roger Montgomery, founder and chief investment officer at Montgomery Investment Management. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.
2 words, Revo Fitness. Here's a few more. Simple, 24/7, reformer Pilates, body scanners, massage chairs, squat racks, free weights, pin and plate loaded equipment, no lock-in contracts, no bullshit. All of that and more from just $9.69 a week. That's surprisingly affordable. Join now at Revo Fitness Victoria Park or download the Revo Fitness app, revofitness.com.au, or find the Revo Fitness app in the App Store.